Welcome to the Deep Dive. We are here to bring you the signal through the noise, distilling massive stacks of research into actionable insight for you. Before we jump into today's material, just a quick word about the analytical power behind these deep dives. Stock Analytics AI. We're committed to making you the most well-informed person in the room. For just €4.99 a month, members get full, immediate access to our massive library. We're talking 500 deep dive videos covering every single stock in the S&P 500. And next up, exclusively for our members, we are rolling out comprehensive coverage of the NASDAQ 100. Plus, if you're a member and you have a stock you're curious about, just drop that ticker in the comments. We'll turn around a deep dive just for you. Like and subscribe to Stock Analytics AI if you want more of this type of analysis. Okay, so today we're diving into that really interesting space where clean energy transition meets, well, national strategic security. We're talking American battery technology company, ticker ABAT. The data we're using is from October 13, 2025, with a closing price of $7.68. And the big question, really the core of this whole deep dive, is this.
ABAT is positioned as America's potential domestic solution for critical battery metals, aiming to break that foreign dependence. But, and this is the key part, can the company actually turn that huge strategic goal, that national imperative, into a sustainable, profitable business for investors?
That's exactly the tension we need to explore, that gap, between the strategic promise and the financial reality. It's the bridge we have to cross today. So our mission is pretty clear. We're unpacking 7 comprehensive chapters of analysis. We'll synthesize the bullish case, which is powerful, look at the bear risks, which are quite acute, and then figure out if that $7.68 valuation holds up based on the fundamentals, assuming they execute perfectly.
Right. Perfect execution being the key phrase there. Let's start by really defining the business model. We are launching into Chapter 1, Business Understanding.
Okay. What's really fascinating about ABAT is that it's not just a one-trick pony. They're going for a vertically integrated, three-pronged model. The first prong, and probably the most visible right now, is lithium-ion battery recycling. They take end-of-life batteries, manufacturing scrap, and process it using their own proprietary method.
And that proprietary process, that's the secret sauce, right? We're talking advanced chemistry, not just like grinding things up.
Exactly. They use what's called a proprietary hydrometallurgical process. So instead of the old-school high-heat smelting pyrometallurgy, which uses a ton of energy and isn't always super efficient, their method uses liquid chemistry. It selectively pulls out the valuable metals. And this is crucial because it aims for a much lower environmental footprint and potentially higher recovery rates.
Okay, makes sense. And what's the actual product coming out of that recycling process right now?
Initially, what they sell are intermediate products. The main one is called black mass.
Black mass.
Yeah, for listeners, just think of it as the concentrated powder you get after shredding the batteries. It's got all the good stuff. Lithium, nickel, cobalt, manganese. But that's just the start. Their longer-term goal, which ties into the other 2 prongs of their strategy, is to move up the value chain, make higher value stuff.
Gotcha. So tell us about those other 2 prongs then.
Right. The second one is primary metals manufacturing. This is about using their new tech to get metals from virgin resources, like straight from the ground. But they're still trying to keep that lower cost and environmental footprint angle. And the third prong, primary resource development, is kind of their insurance policy, securing their own domestic sources of minerals. Their big claim in Nevada, the Tonopah Flats lithium project, is huge. If they get that fully ramped up, the goal is 30,000 tons of battery-grade lithium hydroxide every year, just from that one claystone deposit.
Wow, 30,000 tons. And the scale is starting to become real already, isn't it? Their first recycling plant in McCarran, Nevada, it's running at over 115% of its initial design capacity.
That's right. The nameplate capacity was 20,000 metric tons a year, and they're exceeding that. It shows the initial tech works at scale.
And that's a huge proof point. Plus, getting added to the Russell 2000 and 3000 indexes back in June 2025. That's a big deal for institutional visibility.
Absolutely. It puts them on the map for serious money managers, and their overall value proposition right now is, it's very compelling. It hits 2 key points. 1, domestic supply. That appeals directly to the U.S. government, national security concerns. 2, the low-cost, low-impact process appeals to the big automakers, the OEMs, who are under pressure with ESG mandates.
And the market itself is just exploding.
Oh, completely. The Li-ion battery recycling market is projected to grow at, something like over 20% CDHR through the 2030s. It's a massive tailwind.
But there are other players, big ones like Redwood Materials, Li-Cycle. What gives ABA a competitive edge, a moat?
Good question. The moat seems to be threefold. First, that proprietary hydrometallurgical tech we talked about. Second, their control over that huge Tonopah Flats lithium deposit. That's a massive resource asset. And third, and maybe most importantly right now, is the government backing. That $144 million competitive grant they won for a second plant is huge. And getting the Fast T41 permitting designation, that speeds up the incredibly complex, often decade-long regulatory process for a project like Tonopah.
So that grant money is non-dilutive, meaning they didn't have to sell stock.
Correct. Non-dilutive capital. And that Fast T41 status, that's a massive advantage that competitors just don't have right now. It cuts through so much red tape.
Okay, that government support is clearly critical, which brings us nicely to Chapter 2, management evaluation, because you can have the best tech and location, but execution is everything.
Exactly. And the leadership team here seems built for exactly that. Execution. The CEO, Ryan Melsert, he's also the CTO. He has a really deep technical background. He was actually part of the founding design and engineering team for the Tesla Gigafactory.
Okay, so he knows what it takes to scale complex, first-of-a-kind manufacturing. That's precisely the experience needed here.
Right, and they didn't stop there. They brought in Stephen Wu as COO in August 2024. His background: scaling up at Rivian, Nuro, Apple. He's an expert in that transition from R&D to high-volume commercial manufacturing.
That hire really signals a shift, doesn't it?
Yeah.
A clear pivot from just developing the tech to actually building and running factories at scale.
It absolutely does. And that transition from R&D to mass production, it's notoriously difficult. We saw the struggles even at Tesla, the production hell. So hiring someone with specific experience in managing that intensity, that scale-up challenge, tells you management really understands the core problem they need to solve.
And how are they allocating capital to support this?
It's all focused on growth.
Yeah.
Aggressive reinvestment into scaling up the recycling facility, developing Tonopah. You won't see dividends or share buybacks anytime soon. It's all about fueling that expansion.
And we mentioned those government grants, over $146 million secured. That's smart financing, avoiding dilution.
Very savvy. But we have to look at the other side of that investment coin. If we look at return on invested capital, ROIC, it's currently deeply negative. Minus 59%.
Ouch.
Yeah, but let's be clear. That's not necessarily a criticism yet. It reflects the huge necessary investments they're making in things like the McCarran facility and the Tonopah project, assets that aren't fully generating revenue yet. However, that ROIC number, that's the metric that absolutely has to turn around sharply in the coming years. It's the proof that the capital allocation strategy is actually working.
Okay, a key metric to watch. Let's move on to the financials themselves. This is where it gets really interesting and, frankly, a bit scary. Chapter 3, financial performance.
Financially, yeah, it's a mixed bag. AB is still a small cap, market cap around $906 million. But the growth numbers are just, well, astronomical. That's what's driving the excitement. Revenue jumped 11,149% from fiscal 2024 to fiscal 2025. Went from about $0.3 million to $4.3 million.
Wow, over 1,000% growth.
Exactly. And the acceleration is key. Q4 revenue in fiscal 2025 nearly tripled compared to Q3. That hockey stick growth curve, that is the bull thesis right there.
But that kind of explosive growth often comes with serious financial strain, right? What about profitability, margins, overall financial health?
That's the scary part. Right now, all the profit margins are deeply, deeply negative. Net margin is minus 1,090%. Yes, minus over 1,000%.
Minus 1,000%. How is that even possible?
It means their net loss is more than 10 times their revenue. They're spending vastly more than they're bringing in as they build out. Free cash flow is also significantly negative. They're burning cash rapidly. And to really underscore the risk, their auditors included a going concern qualification in their report.
Okay, hold on. Going concern. Can you break that down? What does that actually mean for an investor looking at this?
Sure. It's basically auditor language signaling a potential risk. It means that, based on current financials, there's substantial doubt about the company's ability to continue operating for the next year without raising more money or achieving profitability soon. It's a standard flag for companies like this, pre-profit, burning capital. It doesn't mean they will fail, but it highlights the urgency of their cash situation.
Right. So huge growth, but huge burn rate, and a warning flag from the auditors.
Yeah.
But there was something crucial you found in the financials, wasn't there? Something showing the underlying business might actually work economically.
Yes, exactly. And this is probably the single most important positive data point in the entire financial picture right now. It's what we call the operational inflection point, seen in Q4 of 2025. In that specific quarter, revenue went up by $1.8 million. Okay.
But the cash cost of goods, sold the direct cost of producing what they sold, only went up by $1.6 million.
So for every extra dollar of revenue they brought in, the direct cost was less than $1.
Precisely. It demonstrates positive incremental gross margins.
Yeah.
It means that on the margin for each additional unit they process and sell, they are actually making money, even if it's not nearly enough yet to cover all their overhead like salaries, rent, R&D, etc.
Okay, that's huge. It means the core process, the hydrometallurgy, isn't just technically feasible, it's economically viable at the unit level. It proves the potential for operating leverage. Exactly. It's the necessary first step. Without seeing that, the whole thing would feel much more purely speculative. It shows a path, however narrow, towards covering those massive fixed costs eventually.
Still, despite that glimmer of hope on the operational side, the overall financial risk remains pretty high.
Oh, absolutely acute. Look at their debt-to-equity ratio. It's exceptionally high at 11.38x.
11 times.
Yep, nearly $12 of debt for every dollar of shareholder equity. That's a highly leveraged position. It magnifies risk tremendously if they hit operational bumps or if interest rates keep climbing, making that debt more expensive. And their cash position, about $25.4 million as of September 2025, they need to manage that burn rate extremely carefully to avoid running out of cash or having to raise more money under potentially unfavorable terms, which would dilute existing shareholders.
Okay, so a really complex picture. High growth, high risk, high leverage. But early signs the core business works. How on earth do you put a value on a company like this? The PE ratio is negative, useless. Price to sales is sky high at 164.
Yeah, that PS of 164 is telling. The market isn't valuing today's sales at all. It's betting heavily, 164 times current sales, on massive future growth. So traditional multiples don't help much. To get a sense of fundamental worth, we have to look forward. We used a discounted cash flow, or DCF, model. It tries to value the company based on the present value of all the cash it's expected to generate in the future.
Right, projecting future cash flows. What key assumptions did you have to make for ABAT given all the risks we just discussed?
We had to use a pretty high discount rate to account for that risk. The weighted average cost of capital, or WACC, we used was 13%. That reflects the operational uncertainty, the high debt, that going concern note. On the growth side, we assumed an aggressive 25% annual revenue growth rate for the first 5 years. That's basically assuming they successfully build out Tonopah and scale up recycling as planned. Big assumptions.
Okay, high discount rate, aggressive growth. What did that simplified educational DCF model spit out as an intrinsic value range?
Based on those inputs, the model suggested an intrinsic value range of roughly $6.50 to $8.50 per share.
$6.15 to $8.50. Okay, that gives us a concrete range to compare against the current price of $7.68. So, given that valuation, let's see how it stacks up against what Wall Street thinks. Let's dive into Chapter 4, Market Sentiment.
Well, here's where it gets really interesting again. There's a noticeable disconnect. The formal analyst consensus is generally positive, like moderate buy or buy, but their average 12-month price target is actually quite a bit lower than the current price. It clusters around $6 to $6.12.
So the stock is trading, what, 26% above the average analyst target?
Exactly. It suggests the market's enthusiasm, maybe fueled by the strategic narrative and those recent growth numbers, is running ahead of where the traditional valuation models of Wall Street analysts currently sit. The market seems to be pricing in that flawless execution already.
And you can feel that enthusiasm in the momentum. The news flow has been incredibly positive lately, the revenue surge, that call to recycle partnership, the huge government grants. Technically, the stock chart looks strong too. It's way above its moving averages, over 107% above the 50-day, over 240% above the 200-day. That's a powerful uptrend.
It is. But there's a counter-argument, a significant group of skeptics. And you see that reflected in the short interest.
Ah, the shorts. How significant is it?
It's pretty high. Depending on the source and calculation, it's somewhere between 10.5% and almost 14% of the free float the shares available for public trading. These are investors betting against the stock. They're skeptical about the company's ability to scale profitably, maybe worried about delays or cost overruns at Tonopah or the overall cash burn.
So, a significant number of bears.
Yes, but that high short interest also creates a specific dynamic. It sets up the potential for a short squeeze. If ABAT keeps delivering positive news and the stock keeps rising, those short sellers might be forced to buy back shares to cover their positions, driving the price up even faster. It adds another layer of volatility.
Definitely a volatile situation.
Yeah.
Okay, let's look at who actually owns the stock in Chapter 5. Ownership structure.
Well, institutional ownership has been climbing steadily, especially after they got into the Russell 2000 index. It's now around 19%.
Mhm.
And you see some big blue chip names among the holders like BlackRock and Vanguard. They've been adding to their positions recently.
19% institutional. That means the rest, over 80%, is held by.
The public. Retail investors like you and me, that high retail ownership definitely contributes to the stock's potential for big swings both up and down.
Makes sense. What about the insiders, the people running the show? What are they doing with their own money?
Insiders, meaning executives and directors, hold about 5.5% of the company. But the really significant signal here came recently. Remember Stephen Wu, the new COO they hired specifically for his scaling expertise?
Yeah, the ex-Rivian Apple guy.
Right. Well, in September 2025, after doing his own extensive due diligence on the operations before taking the job, he went out and bought 12,240,799 shares on the open market, spent about $1.33 million of his own money.
Wow, $1 million bet by the new COO right after joining.
Exactly. When a top executive, especially one brought in for operational scale-up, puts that much skin in the game, it sends a very powerful message. It suggests a high degree of internal confidence in their ability to actually execute the plan. It's a strong vote of confidence.
That's a really compelling data point, balancing some of the financial risks. Okay, let's put it all together in a structured way. Time for Chapter 6, Risk Assessment. Let's start with the internal SWOT analysis, strengths and weaknesses.
Okay, strengths are pretty clear by now. The proprietary technology, that integrated model covering recycling and primary resources, controlling that huge Tonopah Flats lithium deposit, and the experienced technical leadership, especially Melsert. Weaknesses are just as clear and quite serious. The history of net losses, that going concern qualification hanging over them, the fact they have limited history operating at full commercial scale, and that very high 11.38x debt-to-equity ratio. Financial fragility is the core weakness.
Right, now let's look outside the company. Opportunities and threats.
The opportunities are massive. You've got the huge growth in EVs and battery storage markets, continued strong U.S. government support, financial and regulatory, the potential to lock in long-term supply agreements, offtake agreements, with big customers, and maybe even new markets popping up, like recycling the vast number of batteries that will be needed for AI data centers as they grow exponentially.
Okay, lots of upside potential. What are the external threats?
Intense competition is a big one. Redwood Materials, Li-Cycle, potentially others, they're well-funded and aggressive. There's the volatility in commodity metal prices themselves. Lithium, nickel, cobalt prices can swing wildly and impact profitability. There's always the threat of a competitor developing even better technology. And as we mentioned, high interest rates are a threat because they make borrowing money for those huge construction projects much more expensive.
But you mentioned earlier that some external factors like global instability could actually help ABAT.
That's the geopolitical nuance, yes. Things like supply chain disruptions, instability in regions like the Democratic Republic of Congo, where a lot of cobalt comes from, or new trade tariffs. These things actually strengthen ABAT's value proposition. Why? Because they highlight the need for a secure, reliable, domestic, and potentially more ethically sourced supply chain right here in the U.S. It makes a company like ABAT seem less like just another materials company and more like a strategic necessity for automakers and the government.
Got it. So global uncertainty can be a tailwind for them. Okay, we've covered a lot of ground. Let's bring it all home in Chapter 7. Conclusion. Can you summarize the core bull case?
Yeah.
Why has the stock performed so strongly?
Sure. The bull case really rests on a few pillars. One, the absolutely massive market opportunity in battery metals driven by EVs and storage. Two, their unique competitive position, the proprietary tech, the integrated model owning Tonopah, plus that crucial government backing acting as a moat. And three, those vital early signs of operating leverage we saw in Q4, suggesting the core business model can be profitable at scale. Essentially, it's a bet that the U.S. will successfully build a domestic battery supply chain, and ABAT will be a key part of it.
Okay, that's the optimistic view. Now, the bear case. What are the big risks investors need to keep front and center?
The bear case hinges almost entirely on the financial fragility and execution risk. The cash burn, the negative free cash flow, that going concern note from the auditors, these are serious red flags about their near-term financial health. Then there's the massive operational uncertainty. Scaling up novel industrial processes is incredibly hard and prone to delays and cost overruns. And the current valuation, around $7.68, is already pricing in a lot of success. It leaves very little room for error. Any significant stumble could hit the stock hard. So pulling it all together, The current price is $7.68. Our DCF model suggested an intrinsic value range of $6.50 to $8.50. Where does that leave us?
It leaves the stock trading right in the upper middle part of our estimated fair value range. So you could argue it's fairly valued today, but only if you believe the company will execute flawlessly over the next few years and efficiently scale into that rich valuation. Ultimately, an investment in AB at this price isn't really about the technology alone anymore. It's a direct bet on the management team, specifically Ryan Melsert and Stephen Wu, and their ability to deliver on this huge strategic imperative while navigating a very tight financial runway. It's a bet on execution.
A bet on execution indeed. That's a really dynamic and thorough assessment. Thanks for breaking that all down. Before we wrap up, here's a final provocative thought for you, the listener, to mull over. We talked about EVs and grid storage driving demand, but think about the exponential growth of AI and cloud computing. Could the sheer volume of battery waste generated by the constant refresh cycle in these massive AI data centers become an unexpected, maybe even primary source of feedstock for ABAT? Could that actually accelerate their path to profitability faster than anyone is currently modeling? Something to think about. All right, that's it for this deep dive into ABAT. Thank you so much for joining us. Please don't forget to like and subscribe to Stock Analytics AI. Remember, members get that full library of 500 S&P 500 deep dives, the upcoming NASDAQ 100 coverage, and you can drop your stock suggestions in the comments for us to analyze.
And just our final but very important disclaimer. This analysis was generated by an AI system. It's intended for educational and informational purposes only. It should absolutely not be considered financial advice. You must conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.